Here's something that doesn't quite add up. Some of the worst investment decisions ever made weren't made by people who didn't know better. They were made by engineers, doctors, lawyers, professors, people who spent years training their brains to think carefully, analyze information, and make sound judgments. And yet, when it came to their own money, they panicked at the wrong moment, chased the wrong trend, or held onto a losing position way longer than any rational analysis would justify. Why? What is it about money that seems to short-circuit even the sharpest minds? That's what today's video is about, not the mechanics of investing, we've covered those, but the part that sits underneath, the psychology. Because here's the uncomfortable truth. Your brain wasn't built for modern financial markets, and until you understand why, it will keep working against you in ways you won't even notice. Welcome to Slowfolio, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Everything you hear here is purely for education, not a recommendation to buy, sell, or do anything specific with your money. All right, so let's start with the foundation. Why does this happen at all? Think of your brain like a smartphone running two different apps at the same time. One app is slow, deliberate, and analytical. It's the part of you that reads a contract carefully, does the math before deciding, and weighs pros and cons. The other app is fast, automatic, and emotional. It's the part that flinches when something flies at your face, feels a surge of excitement when something looks like a deal, and experiences real pain when you lose something. For most of human history, that second app, the fast, emotional one, was the one that kept us alive. Snap judgments about threats and opportunities were survival tools. But in financial markets, those same instincts consistently backfire. The market drops 20%. Your fast brain screams danger, sell everything. A stock has doubled in 3 months. Your fast brain says this is a winner. Buy more. Neither response is driven by analysis. They're driven by wiring that evolved long before anyone invented a stock exchange. This field, where psychology meets investing, is called behavioral finance. What it has documented across decades of research is that humans are not the rational decision makers that classical economics assumed. We are predictably, systematically irrational in ways consistent enough to be studied, named, and, if you know what to look for, partially managed. Let's talk about the first big one, because it's probably the most expensive mistake most investors make: loss aversion. Here's the core finding, established by psychologists Daniel Kahneman and Amos Tversky. Losing something feels roughly twice as painful as gaining the same amount feels good. Losing $100 hurts approximately twice as much as winning $100 feels rewarding. The pain and the gain are not symmetric in our minds, even when they're perfectly symmetric in our bank accounts. Think about what this means in practice. When your portfolio drops $5,000, that emotional experience is roughly twice as intense as the positive feeling when it gained $5,000. So when markets fall, the pressure to do something, to stop the pain, to get out before it gets worse, is not proportional to what the numbers suggest. It's amplified by how our brains are wired. This is why people sell at the bottom. Not because they've done the analysis and concluded the market won't recover, but because the pain of watching the number drop becomes emotionally unbearable, and selling makes it stop, at least temporarily. The long-term cost of that decision, locking in the loss, missing the recovery, arrives much later when the urgency is faded. Loss aversion also explains why people hold losing investments far too long. Selling a stock that's down 30% means turning a paper loss into a real one, and that feels like admitting defeat. So investors hold and hope, waiting for it to come back, long past the point where rational analysis would have said move on, Now let's talk about the second pattern that trips up even sophisticated investors: overconfidence and its close cousin, confirmation bias. Study after study shows that the vast majority of people rate themselves as above average drivers, above average at their jobs, and above average investors. Statistically, that's impossible. But what's interesting isn't that people are wrong about their abilities. It's that they're wrong in a specific, consistent direction. And the effect is strongest in domains that are complex, and where feedback is delayed, which describes investing almost perfectly. When an investment works out, your brain attributes it to skill. When it doesn't, your brain blames bad luck or unusual circumstances. Over time, this creates a distorted record. Wins become evidence of judgment, losses become anomalies. And you end up with an inflated sense of how good your instincts actually are. Confirmation bias makes this worse. Once you've formed a view on an investment, you start unconsciously filtering information to support it. You read the bullish articles more carefully. You dismiss the bearish ones as biased. You talk to people who agree with you. None of this is deliberate, and it just happens. And your conviction strengthens even when the actual evidence hasn't changed. The result? People trade too much, take on too much risk, and hold concentrated positions too long, not from superior analysis, but from a brain that genuinely believes it's better at this than it is. There's one more pattern worth unpacking, because it's especially powerful in the age of financial media and social feeds: herding, or what behavioral economists call social proof. Human beings are wired to look at what others are doing as a signal of what's safe and correct. In most contexts, this is useful. If everyone at the restaurant orders the same dish, it's probably good. But in financial markets, following the crowd doesn't lead to safety. It leads to buying high and selling low. Here's the twist. The more visible a market trend becomes, the more it shows up on news channels, social media, and dinner conversations, the more likely the opportunity has already been priced in. By the time everyone is talking about a hot sector or a surging asset class, the early buyers have already made their gains. The latecomers arriving on social proof are often buying near the top just before the narrative reverses. This is also how market bubbles form. Each individual investor, watching prices rise and seeing everyone around them participate, feels the pull to join in. FOMO overrides the analytical question of whether the price still makes sense. The dot-com bubble, the 2008 housing crisis, the crypto boom and bust, herding and FOMO are visible in all of them at scale. Let's make this concrete with two investors, Maya and Felix. Both are 35 years old, both invested in a diversified index fund. Then March 2020 arrives. The market drops roughly 34% in about 5 weeks as COVID-19 hits global markets. Fast, brutal, and genuinely frightening. Maya's brain goes into full loss aversion mode. The pain of watching her portfolio fall feels overwhelming. She tells herself she'll get back in once things stabilize and sells near the bottom. By the time the news feels less catastrophic and she's comfortable re-entering, it's late 2020. The market has already recovered most of its losses. She buys back in significantly higher than where she sold. Felix does something much harder than it sounds: nothing. He keeps his automatic monthly contributions running. He doesn't check his portfolio daily. He acknowledges it feels terrible, because it does. But he reminds himself he doesn't need this money for 20 years. And that his analytical brain, not his emotional one, should be making this call. By end of 2020, his portfolio has fully recovered and then some. Same market, same starting position. Two completely different outcomes, not because Felix had better information, but because he understood what his brain was trying to do and chose not to follow it. So what do you actually do with all of this? The first thing worth knowing is that these biases don't disappear just because you're aware of them. Kahneman himself, one of the founders of behavioral finance and a Nobel laureate, has said that understanding cognitive biases doesn't make you immune. You'll still feel the pain of losses more sharply than the joy of gains. Knowing the name of the trap doesn't automatically keep you out of it. What awareness does give you is a pause, a moment between the emotional impulse and the action where you can ask, is this a decision I'd make if the market were closed for the next 5 years? Is this analysis, or is this fear? Is this conviction, or is this FOMO? The second step is to build systems that reduce how much you rely on in-the-moment judgment. Automatic contributions remove the when to invest decision from your hands entirely. A simple written note to yourself, why you're invested, what your time horizon is, what you'll do when markets drop, gives your analytical brain something to hold on to when your emotional brain is loudest. And third, be genuinely humble about the limits of your own judgment, not as self-criticism, but as a realistic recognition that markets are made up of millions of smart, motivated participants, and consistently outsmarting all of them is a much harder task than it feels in the moment. The truth is, the best investors aren't the ones who feel no emotion about their money. They're the ones who feel it just as much as everyone else, and have built enough structure around their decisions that the emotion doesn't get the final word. Being a good investor isn't about being smarter than the market. It's about being smarter than your own instincts. And that's a skill anyone can build, one decision at a time. If you found this helpful, please like and subscribe to keep growing the Slow Folio community. Thanks for watching, and see you very soon.